Hello and Assalamu alaikum. In this video, in this session, we'll be discussing one of the SBR current issue, that is crowdfunding and impairment of financial instruments. Okay, so what is crowdfunding? Firstly, what is crowdfunding? Crowdfunding is the funding of a new startup or a project by collecting cash from a variety of individuals, entities, often via the internet. Okay, and there are four ways of raising funds. Okay, so crowdfunding is a way of starting a new startup, that means a new business or a project, by collecting cash from a variety of individuals or either the entities, often via the internet. We talk to companies or the individuals over the internet, that and we pitch them our idea to them, that this is our idea, this is my business, and I need funding for my business, and in return I will give you the returns, and I can give you the returns in the various way. That is crowdfunding. And what are the four ways of crowdfunding now? The equity based approach is targeted at investors who receive shares in the new company. That is, for example, I giving them, I said, give me 100,000, I will give you a 10% equity share in my company. Or debt-based crowdfunding. With debt-based crowdfunding, a contributor makes a loan to a business that's looking to crowdfund with the intention of subsequently being repaid with interest, right? It will be just like a loan, that, okay, I'm giving a loan, I will give you a loan, I will take an interest on it and a principal amount as well. Now, then we have reward-based crowdfunding. This involves promising specific items, rewards to contributors before the launch of a new product or business. Okay, a reward-based campaign isn't generally targeted contributors who are looking to profit from their investment, but at those who want a own a new product. For example, investors will not ask you a equity in the business. They won't ask for a loan payback, but they will say, when before launching your product in the market, give one of the item of a product to us. For example, a company launched an electric car, right, which is very much efficient, right, which will cost $10 to recharge the car, and it's very efficient now. So they said that give the use face recognition to unlock the device. So give us that one product, and you don't need to pay us or give us any equity share. That's reward based crowdfunding. Then we have donation based crowdfunding. Contributors make donations to a project or a company and may receive existing rewards in return. Some forms of donation-based crowdfunding don't involve any of sort of reward, as donors wish to contribute to further a particular cause, right? They won't ask for you in donation-based crowdfunding. They will be donating you for a particular cause. For example, building of a mosque, a temple, a church, whatever it is, and they are just donating for a cause. They won't take any equity share in it. They won't take any they won't back their money back as a loan, or they don't want any rewards as well. That's donation based crowdfunding. Now, if the crowdfunding is considered to be a debt instrument, it will fall within the scope of IFRS 9 financial instruments, whereas if it gives rise to an issue of capital, it will fall within the scope of IAS 32 financial instruments. If the crowdfunding campaign involves the issue of rewards, then IFRS 15 revenue from contracts with customers should be used to determine when to recognize revenue. For each performance obligation, the company will need to determine whether the performance obligation is satisfied over time or service transfer to the customers over time. If one or more of the criteria in IFRS 15 are met, then the company recognizes revenue over time. If none of the criteria is met, the control over to the customer at a point in time, and the company recognizes revenue at that point in time. However, if the company cannot reasonably measure the outcome but expect to recover the cost incurred in satisfying the performance obligation, then it recognizes revenue to the cost incurred. For example, on 1st September 2009, Burnett Company decided to undertake a crowdfunding campaign to finance the production of new racing bike. The Kraken, they made a short film with famous cyclists which set out the quantities of the Kraken bike and posted it on the pedal starter at a crowdfunding platform. The campaign raised 4 million on which pedal starter charged 7% commission. The contributors to the crowdfunding campaign were promised a reward of one Kraken bike for every $4,000 contributed. At the financial year end of 31st December X9, Burnett Company had manufactured only 50 Kraken bikes at a total cost of 240,000, but none had been delivered to contributors. There was some doubt as the capability of the company to develop, manufacture, and deliver the bikes promised, but Burnett Company assured that the funding will cover any cost incurred. So here is a suggested answer for it, that IFRS 15 revenue from contracts which customers should be used to determine when to recognize the revenue at 31st December at time. It is difficult to know what the outcome will be as only 50 bikes have been manufactured out of promised 1,000 bikes, 4 million out of $4,000, that is 1,000 bikes, and there is a doubt as to whether the company has the capability to develop, manufacture, and deliver the bikes promised. However, Burnett Company expects to recover the cost incurring in satisfying the performance obligation. Thus, it will recognize revenue to the extent of the cost incurred to the date, that is 240,000 plus 280,000 commission, total 520,000 as at 30th first December 2009. The balance remaining from the commission, 280,000, would be charged as to the profit or loss for the period as an expense. Now, uh, many SBR students, candidates may know have some extra time and reflect and think the values, concerns, routines, one of which may be their approach to study. It may be a time to focus on accounting techniques, but on accounting principles to move, maybe read around the subject and gain an understanding what lies behind it. So remember 3 points. Importance of the robust conceptual framework and understanding that rules will not be able to cover all situations. Use of reasonable judgment is always needed in decision making process. Okay. Now the impairment of financial instruments. One technical area of the SBR syllabus is candidates that often struggle with is the impairment rules of IFRS 9. Financial instruments uses an expected credit loss model which requires a calculation of the expected value, decrease in a financial asset. Essentially, a provision is required for expected credit losses on the financial asset over a period of time. Expected losses should be discounted to the reporting date using the effective interest rate of the financial asset that was determined at initial recognition. Um, okay, so as far as the impairment model is concerned, the impairment model of IFRS 9 introduces a three-stage approach. Stage one deals with financial instruments that have not had a significant increase in credit risk since they were first recognized or that have now low credit risk at the financial year end. For these assets, 12-month expected credit losses are recognized, which means that the entity has to calculate the expected losses in the next 12 months, taking into account the risk of default. Any interest revenues calculated on the gross carrying amount of the asset without the deduction of the credit loss. Stage two deals with the financial instruments that have had a significant increase in credit risk since they were first recognized, unless the credit risk is still low at the financial year end. These instruments are not credit impaired. The expected losses over the life of the financial instrument are recognized lifetime ECL, that means expected credit losses, taken into account the risk of default, or they are still calculated on the gross carrying amount of the asset. Okay, so third stage deals with financial assets that are credit impaired, which is where events have occurred that have a determinal impact on the estimated future cash flows from the financial asset. Okay, for these assets, lifetime ECL are also recognized. However, interest revenue is calculated on the carrying amount less the ECL allowance. Interest revenue minus ECL. Okay, now here is our example, another example. On 1st January 2006, Lunar Company granted Spicer Company a 5 million secured loan repayable on 31st December X9 with an interest rate of 3% payable annually at the reporting date. Stage 1, for 31st December 2006, there has been no increase in the credit risk, and the probability of the default in the next uh, 12 months is 5%. The present value of the cash shortfalls expected over the life of the instrument if the default occurs in the next 12 months is $2,000, 200,000. So 12-month ECL, 200,000 into 5% is 10,000. Interest revenue, 5 million into 3%, 150,000. No adjustment required for any loss allowance because it is immaterial in this case. And stage 2, on 31st December X7, the credit risk of the loan has increased significantly. The probability of the default occurring over the remaining life of the loan is 45%. The present value of the ECL from default events over the life of the loan are expected to be 400,000. Lifetime ECL 400,000 into 45% is 180,000. Now the change of 170,000 in the cumulative impairment allowance is recognized in profit or loss as an expense, whereas interest revenue 5% into 150,000, no adjustment for any loss allowance in this case. Then stage 3, on 31st December X8, the loan is credit impaired. The estimated present value that is expected to be recovered less cost is 4 million. The carrying amount on the loan is 5,150,000, which is the loan plus unpaid interest for the year. So the lifetime ECL expected credit loss is 5.15 minus 4, that is 1.15 million, and the change is of 0.18 million minus 1.15, that is 970,000 in the cumulative impairment allowances recognized in P&L as an expense. 2009 interest revenue will be 4 million of 3% is 120,000, which is based on gross carrying amount minus loss allowance. Okay, for the trade receivables or contract assets that do not contain a significant financing component, the loss allowance should be measured at initial recognition and throughout the life of the receivables at an amount equal to the lifetime ECL as an exception to the general model. If the credit risk of the financial instrument is low at the reporting date, management can measure impairment using 12-month ECL, and so it does not have to assess whether a significant increase in credit risk has occurred or not. So that's it for this part. And I hope you get this current issue. It is one of this can be a potential current issue question in your upcoming exams. So do revise it before exams as well. I will see you soon in the next video. Till then, take care. Bye bye.